Hi everybody, welcome back to Chapter 10 and our discussion of Illustration 10-6 in your textbook. In addition to recording the capitalized cost of the coal mine and the excavation equipment, as we saw in our last video, the company must also account for the difference between the asset retirement liability of $468,360 and the probability weighted expected cash outflow for restoration costs of $590,000. The difference is recognized as accretion expense, which is an additional operating expense that accrues over the 3-year excavation period. This process will increase the balance in the asset retirement liability account from the $468,360 initial balance to the $590,000 estimated restoration costs by the end of the excavation period. The calculation of the annual accretion expense is easy. Multiply the balance in the asset retirement account by the company's credit-adjusted risk-free interest rate, 8% in this example. So for year 1, the accretion expense is $37,469. calculated by multiplying the initial balance in the account of $468,360 times 8%. The journal entry to record the accretion expense is a debit to accretion expense and a credit to the asset retirement liability. This means that the balance in the liability account increases each year by the amount of annual accretion expense. At the end of year 1, the balance in the asset retirement liability account was $505,829. The initial balance plus the first year accretion expense of $37,469. The second year accretion expense is $40,466. The balance at the end of year 1, $505,829 times 8%, and so on. By the end of the expected life of the asset retirement liability will be equal to the initial estimate of the expected cash outflow for restoration costs. You can see here by our schedule that by the end of year 3, the asset retirement liability account grew to $590,000, which was the company's original estimate of cash outflow for restoration costs. It's important to remember that the cash flow for asset retirement costs was an estimate made on the date the asset was purchased, 3 years ago. And, as with all estimates, the actual amount that will ultimately be paid for restoration costs might be more or less than the original estimate. If the actual restoration costs are more than $590,000, we will recognize a loss. If the actual restoration costs are less than the $590,000, we will recognize a gain on the retirement of the obligation. For example, suppose that the actual restoration costs were $625,000. in order to record the payment of the $625,000 of actual restoration costs after year 3, we will need to debit the asset retirement liability for $590,000 to remove this liability from the books. We will need to credit cash for the $625,000 paid for the actual restoration costs. And we will need to debit a loss on asset retirement liability for $35,000. It's time for a bonus break. Let's continue with our Chapter 10 scavenger hunt. The scavenger hunt bonus phrase for this video is, do you have? Let's do a concept check problem. The Winder Mining Company paid $50 million for the right to explore and extract copper from a land owned by the state of Wyoming. To obtain the rights, Winder agreed to restore the land to a suitable condition for other uses after its exploration and extraction activities are complete. Winder incurred exploration and development costs of $15 million on the project. The company's credit-adjusted, risk-free interest rate is 6%. It estimates the possible cash flows for restoring the land 3 years after extraction activities begin to be a 40% probability that $5 million will be paid for the restoration costs, and a 60% probability that $10 million will be paid for the restoration costs. What is the initial cost of the copper mine? Please pause the video to prepare your calculations. You might find it very helpful to refer to illustration 10-6 as you do your calculations. After choosing your answer, please start the video again to check your work. The correct answer is C, $71,716,960. That is calculated as the cost of the mine, $50 million, plus $15 million of exploration and development costs, plus the present value of the estimated cash flows for restoring the land. That's $5 million times 40%, plus $10 million times 60%, for a total of $8 million of possible cash flows for restoring the land, times the present value factor, where I equals 6% and N equals 3. So the present value of the $8 million estimated restoration costs is $6,716,960. So the total cost of the mine is $50 million plus $15 million plus $6,716,960. Well, that's all for this video. In the next video, we'll begin a discussion of exchanges of assets. See you next time.